Good morning, traders. Today is Tuesday, February the 18th, 2014, and this is your Forex market commentary brought to you by real ECN. If you're holding the dollar-yen position, then today's commentary will provide you with a degree of insight in formulating your trading strategy to trade today's risk event, which is the Bank of Japan announcement. The recent weak prevailing theme has been risk aversion and fear from emerging market. Now, sentiment has shifted where risk appetite is slowly returning, and we will discuss how this might play into the dollar-yen trade. And first, in line with our dollar-yen discussion, we're going to look at the market on the technical front. It is no surprise that yesterday dollar-yen reversal was greatly attributed to the bounce in the equity market due to the highly correlated nature of the pair with risk appetite. Recent market volatility has fallen greatly, and this tends to imply that the outlook for the Japanese yen in general will likely to weaken, largely on the basis that risk appetite is back on and the appeal of safe haven is slowly diminishing. The dollar-yen market bottomed out from yesterday's trading session at 101.43 level before upward reversal took place as the pair flipped with the 102 level. If the pair can break out from the 102 trading range, this exposes the trend to a new target of 102.95 to clear out in order for the bullish momentum to fully gain traction. In accordance to the SSI, the Speculative Sentiment Index, retail traders' conviction towards their net US dollar Japanese yen position has remained intact, with several offloading of their long-term position amongst the weak January US non-farm payroll and Janet Yellen dovish testimony. Nevertheless, there hasn't been a fundamental shift in sentiment yet. The recent string of disappointing US economic reading has traders upgrading speculation that the tapering program instigated by the Fed may be stalled. Thus, risk appetite is slowly returning, to which the Japanese yen is the source of that funding. Analysis of a collection of technical indicators on the hourly chart interval on the dollar-yen market suggests a temporary bullish market sentiment and recommends short position on the greenback based on a series of technical indicators. The hourly chart established short-term Fibonacci resistance at 101.98 and Fibonacci support at 101.86. The dollar-yen market began the week trading below the 200-day simple moving average. This trend action holds great significance as 200-day simple moving average contain more or less 1 year worth of trading data, and it forecasts long-term market sentiment. And currently, the peers are trading below the 200-day simple moving average, which is indicative of long-term bearish market sentiment outlook on the cross moving forward. This bearish market sentiment is not shared by the short-term simple moving average, as the dollar-yen pair opened today's Sydney trading session above the 5, 10, 20, and 30-day simple moving average, which is indicative of a buy recommendation on the technical front. Now let's explore the VIX index. VIX index is a gauge for fear in the market, and trends show that volatility had peaked off during the emerging market scare, but on a decline after the Janet Yellen testimony, as the market perceived possible tapering of the taper based on consistent weakening in the US leading economic indicators. Moving down here, we have the S&P 500. The S&P 500 measures risk appetite. It is highly correlated to the dollar-yen market and often used as the directional gauge in the dollar-yen cross. After a correction in late January to February, the S&P 500 has rebounded. The 1850 target on the S&P 500 is what analysts are using as a risk benchmark to establish conviction to a forlorn risk trend. Now let's touch on the fundamental front on the dollar-yen market. First in line, being that yesterday trading session was a national holiday for the US market, market participation and volume was relatively low. Therefore, trend establishment during yesterday's trading session lacks convictions, as traders avoid the return of liquidity when the New York market opens today. By then, the market would see where the risk trend can fully materialize. Recent release of Japanese GDP number has market losing faith in Abenomics and his policy. Market GDP release show a reading of 0.3% expansion quarter on quarter, missing market expectation of a 0.7% reading, while year-on-year GDP grew at a pace of 1% below market estimate of a 2.8%. This casts a shadow of doubt to the recovery that Abenomics had failed to deliver, capping off with industrial production slowing, showing a reading of 0.9%, missing expectation of 1.1% reading. The Bank of Japan press conference would take place today as the market await further plan of action as the recovery story is coming under pressure. Market are expecting a continuity to the Bank of Japan benchmark rate to remain at 0.1%. However, traders are expecting more dovish language out of the Bank of Japan regarding upgrading their accommodative policy to suppress any potential Japanese yen appreciation that can hurt economic recovery or export. One impending concern for the Japanese yen economy in 2014 is the consumption tax increase, which will be implemented in April. This will surely slow down consumption and ultimately CPI reading as money velocity slow. Therefore, in line with expectation, it only makes sense that the Bank of Japan will add further accommodative policy to offset the slowdown in domestic consumption. In the case of the Bank of Japan give the market what it wants, this can give the dollar-yen the bullish momentum to break out from the trading congestion to the upside. To conclude this commentary, I want to wish everybody a successful trading period. And thank you for listening, everybody.